Good afternoon, everyone. This is James Fields from Klingenstein Fields Wealth Advisors. Thank you for joining us today. We're just going to wait another minute or two as people are piling into our webinar here before we begin. Thank you. Good afternoon, everyone. Thank you for joining us today. I'm James Fields, President of Klingenstein Fields Wealth Advisors. I'm glad you could join us on this call. Hope that everyone is safe and healthy. And for those families that have celebrated recent school graduations or other milestones, congratulations. We are happy to be here talking with you today, but we miss our in-person interactions and are hopeful that we are edging closer to the point where we can resume them. While we are here to discuss the financial markets, we would be remiss not to acknowledge the larger issues rolling our country. As we focus on the markets, we hope each and all of you join us in taking time to contemplate your part in making this country a better and more inclusive place for everyone. We've gotten a lot of questions recently on the fixed income markets, so we thought this would be a good way to answer some of those questions and others that listeners may have. We welcome any thoughts on topics that you'd like to hear about in the future webinars. Please just let us know. As always, we encourage you to continue to reach out to us with any questions or concerns that you may have. Today, I'm going to give a brief update on what's going on in terms of the equity markets, parts of the country that are starting to reopen, and other developments and their implications. After that, I'm going to turn over to my partner, Mike Champness, Senior Vice President of Klingenstein Fields Wealth Advisors, and Justin Land, President of Wasmer Schroeder, to give Wasmer Schroeder's outlook for fixed income. Wasmer Schroeder has been managing taxable and tax-exempt fixed income strategies for over 30 years and has over $10 billion in assets under management. Klingenstein Fields has worked with Wasmer for several years, and the name may be familiar to some of you as part of your investment portfolio. Justin has been with Wasmer since 1993 and has deep knowledge of the fixed income markets. Today's call will cover traditional fixed income, which is what we typically use in client portfolios. There are other ways to get fixed returns and generate income streams that are not fixed income, such as real estate and alternatives. If anyone is interested in discussing them, again, I encourage you to reach out to your advisor. Mike and Justin will give a brief recap of what's taking place in the fixed income markets in 2020 and where we are today, and then give us the outlook for 2020 and beyond. After that, we will have question and answer session and welcome any questions that you may have. Any questions that we do not get to during the call, we will follow up on individually to make sure that they are addressed. During this call, you can submit questions in one of two ways. If you are listening through your computer, there's a widget on the right side where you can submit questions. Or you can email them at any time to Susan, S-U-S-A-N, .curry, C-U-R-R-Y, @klingenstein.com. That's KLINGENSTEIN.com. So, what happened recently in terms of the impact of COVID-19 and the economy? Since the end of May, we've seen both good news and not so good news in terms of the cases of COVID-19. The good news is that many of the first hard-hit areas, including Greater New York, where we're calling from, New Jersey, and Connecticut, continue to improve, with ongoing drops in daily reported cases and hospitalizations. In fact, daily reported cases have dropped dramatically, far below even a few weeks ago. As the health situation has improved, restrictions have continued to ease. New York City officially entered phase 2 this week after a phase 1 reopening on June 8th. The first opening allowed for construction, manufacturing, and limited non-essential retail activity to resume, and this week, traditional retail and outdoor dining were added. Connecticut entered phase 2 on June 17th, which opened about 95% of that state's economy, with restrictions and limitations regarding capacity, social distancing, and other requirements. New Jersey remains a week or two behind. We are hopeful that this positive trajectory is maintained and that economic activity nationwide picks up. As things begin to reopen, we do believe we have seen the economic bottom. In fact, there have already been some hopeful signs, with May retail sales up sharply from the April bottom. In addition, the May unemployment numbers showed unexpected improvement, while they are still at historic highs. There's also been an uptick in air and other travel as Americans begin to venture out and about again, at least domestically. It is important to keep in mind, however, that the economy is still very much in a state where government stimulus and fiscal policy is playing a huge role in supporting it. The government, particularly the Federal Reserve, has given every indication that it will do what it needs to do to maintain that support. We remain cautious, though, and continue to monitor the situation carefully, especially as some states that have eased restrictions have experienced an uptick in cases, as would be expected with an increase in activity and testing. In fact, 33 states have seen an increase in cases in the last 2 weeks over the previous 2. And just moments ago, the governor of Texas announced a pause in the reopening of that state, including a slowdown in elective surgeries. It is this type of news that the market is reacting to mostly in the short term. And on June 10th, we saw the market experience its worst drop since March based on news of cases spiking in reopened states. And then a strong sell-off yesterday as markets digest record daily new cases in Florida, Texas, California, and Arizona, among other states. Additionally, in a few weeks, companies will be releasing second quarter earnings, which will likely result in more short-term market activity for specific companies and industries. Volatility is clearly here to stay. We believe that this will be the environment for the third quarter and probably for the balance of the year, as the economy and markets slowly begin to recover while reacting to short-term market noise. Our focus, as always, is to invest in the long term, developing portfolios based on your needs and goals. Our aim is to weed out the noise, understand long-term fundamental market changes and shifts, and make decisions based on hard information and data. Part of this analysis includes looking at what is going on currently and how it is affecting the markets, particularly those that are impacted the most from COVID-19 and the response, such as healthcare, technology, consumer-oriented industries, travel, and leisure. We try to identify those areas that may represent long-term risk, as well as opportunities to benefit from fundamental shifts in the world, particularly as we consider a new normal. So that wraps up our current view of where things stand in the broader equity markets. We've spoken to many of you individually and encourage you to continue to reach out to your advisor with any questions you may have regarding your portfolio. So let's now turn to fixed income. At Klingenstein Fields Wealth Advisors, we create bespoke portfolios based on each client's specific needs, risk profile, spending requirements, tax circumstances, and other idiosyncratic considerations. We also believe in asset allocation and portfolio diversification to provide exposure to different asset classes for both return opportunities and risk management. Depending on these considerations, we may allocate to different types of fixed income, including Treasuries, corporate securities, and municipal bonds. Now I'd like to turn over to my partner, Mike Champness, Senior Vice President of Klingenstein Fields Wealth Advisors, and Justin Land, President of Wasmer Schroeder. They're going to talk about what's going on in the fixed income markets in general and dive into some specific fixed income categories to provide further thoughts and perspectives. Michael?
Thank you. Good afternoon. My name is Mike Champness. I'm a Senior Vice President at Klingenstein Fields. I've been with the firm for 16 years. I spend most of my time following companies and researching equities, but I also oversee several other initiatives at the firm to help manage our clients' assets consistent with their individual investment objectives, risk tolerance and constraints, time horizon, and liquidity needs. One of the things I'm responsible for is overseeing the process around our third-party fixed income manager, Wasmer Schroeder. I led the process to select them as our partner, and I managed the process to make sure they are investing our clients' assets according to the client's plans and needs. Let me step back and give a quick overview of that relationship before I turn it over to them. For clients seeking a conservative approach to fixed income allocation, i.e., they seek safety and diversification first, followed by some income and perhaps a view towards investment performance, we believe an allocation to Treasury securities can be appropriate, since Treasuries are backed by the government and are highly safe. Given the lower risk, Treasuries often have lower yields than other bonds, so we can implement or supplement that with an allocation to tax-efficient municipal bonds from a client's home state. For clients seeking broader diversification in their fixed income allocation through investments in municipal and taxable fixed income products, we have partnered with Wasmer Schroeder. The word partner is highly intentional here, as Wasmer Schroeder is designed to work with advisors like ourselves and manage the fixed income piece of a client's portfolio. With their research analysts and portfolio managers, Wasmer has a team of approximately 20 investment professionals dedicated to researching credits and constructing portfolios. They're a great match for us because they have a similar perspective on risk, and they can construct portfolios individually based on a client's needs. This is not investing in a fund alongside thousands of other investors that may have totally different investment needs. Some examples of clients who may be in the market for a more diversified strategy include a client that has a very complex financial picture, a client that has a more substantial dollar amount or percentage of their wealth to commit to fixed income, a client that needs to match future cash outflows or liabilities with predictable investment income, a client who within their financial plan has a need to target specific metrics like a duration, or most likely a client who is simply more comfortable owning higher yielding securities, even if they are still high quality, high grade bonds, or wants some greater corporate bond exposure or something else. You needn't look beyond the most recent market disruption to see the value of credit research. Take the municipal market, for example. With COVID-19, different states and municipalities will be impacted by underlying unemployment that has spiked due to the virus, and the ability to collect tax revenues will be altered in these municipalities in different ways. Will a state dependent on tourism, hotels, and gambling be impacted in the same way as one dependent on manufacturing or financial services? How strong was the balance sheet of the underlying entity before the virus shut down the economy? Will the virus cause people to move out of cities, cutting the income tax base and perhaps driving bankruptcies in restaurants and local businesses? Just a few questions can highlight the value of in-depth research in these markets. This underscores the value of credit-focused portfolio construction for both municipals and for taxable fixed income that a firm like Wasmer provides. Wasmer is also a valuable resource to us through the white papers and research they publish on all aspects of the fixed income markets. With that, I will turn it over to Justin Land to discuss what he is seeing in the markets today and give any additional introduction to himself or his firm that he sees fit. Justin is president of Wasmer Schroeder and has been our portfolio management contact since we began our relationship. Justin, thank you for taking the time today. Please go ahead.
Mike and James for having me on, and thank you to everyone who's attending today. These are interesting times. Just as a quick background on Wasmer Schroeder and myself, we've been in business since 1987, and we are a fixed income separate account manager based in Naples, Florida. Unfortunately, as James mentioned, Florida is one of the hotspot states. I've been with the firm since the early 90s in our research, portfolio management, and strategy roles, and am now president of the firm. I think it is important to mention that if you Google us right now, we are independent, but next week we'll be being acquired by Charles Schwab. We're very excited to get access to the resources for our existing client base that Schwab can bring to bear on technology. And what I think is one of the most important discussions right now is credit. So we currently have 6 municipal analysts, and we'll have access to another 9 once the acquisition goes through, which I think is great, especially in a time of such uncertainty as we have going on now with COVID-19 and shutdowns and reopenings and re-shutdowns. To start with a broad perspective, going into this year, we were at, in the fixed income markets, almost all-time low yields on virtually every fixed income asset class domestically. COVID-19 came along. We saw a lot of market volatility in March, with credit spreads in both the corporate market and the municipal market widening dramatically, while Treasury yields fell to all-time lows. Since then, as James mentioned, two significant things have occurred to really support the market. The first was the CARES Act that was passed and gave stimulus checks to individuals around the country that provided better unemployment benefits, and for the municipal market provided a lot of direct support in direct aid for state and local governments, specific aid for mass transit, higher education, healthcare, airports, and the like. And so that was really an important piece to bring about confidence with such a dramatic slowdown in the market, in the economy, just something unprecedented. Normally going into recessions, they take time to get to peak unemployment, and we've gotten too close to record unemployment in the space of about 60 days. As James mentioned, a second key piece has been the Fed's willingness to make sure the market stays liquid. They're buying corporate assets, they're buying treasuries, and for the first time ever, they are buying municipal bonds as well, because they understand the importance that, especially in a crisis that's a health crisis around the country, state and local governments need to be able to provide services in a time of stress like this, and they want to make sure that happens. So, where we stand today is most high quality municipal bonds are near their all-time lows in yield. So that's a great positive. It means that state and local governments are able to finance existing and future cash flow needs at very, very cheap levels. So there's kind of the good news. The bad news, we have 15% or higher unemployment. We've seen sales tax revenue in most states fall by roughly 25% in April, although we did see a rebound in May, and we're expecting some of a rebound in June as well as things get restarted. That puts a big hole in budgets really quickly. As I mentioned, the states have gotten a lot of money from the federal government. We expect, though, that will likely not be enough. And what that means is, one, we may see another stimulus bill in July. There's already talk of it, and there'll be political wrangling about whether it happens and who it helps. And two, if that doesn't occur, what we will see, and we're going to need to look at a city by city, county by county, and state by state basis, is how these municipalities balance their budgets. And we really think that the municipal market is a highly safe market. It's highly essential, has very low default rates, and we don't think that will change. But what we're really watching is policy decisions. So are governors and mayors making the tough choices around either cutting expenses or raising revenues and taxes, or are they just hoping for money that will someday come, or an economic rebound that may not occur as quickly as they'd like? And that's really how we go about managing credit. I also think it's very important to underscore the fact that there are certain specific sectors of the municipal market that may be under sustained stress. So those would be things like convention centers and stadiums, senior living facilities, single-use toll roads, those things that may take much, much longer to return to quote-unquote normal as we work in digging ourselves out of this giant economic hole. So the way we view credit is it's really an issuer by issuer analysis, and it's bottom up. especially in a market like this. What's going on in Anaheim, California with Disneyland is very different than what might be going on in Detroit for the auto sector. And so we can't say all municipal bonds are good or all municipal bonds are bad. It's really about issuer by issuer decisions. And I can tell you, our credit analysts are busier than they've ever been in years. And that's to maintain the safety and security for our client portfolios. A last thing before we open it up to questions. The Fed has been very proactive, as I mentioned. With that in mind, we have the expectation that they will make sure one way or another, whether outright buying, yield curve control, etc., that rates will stay very low for a very long time. And that they are cognizant that there may be long-term consequences, but the need to get the economy back on some firm footing is important enough that they're willing to take those risks. So from there, I'll open up for James or Mike if they have anything more to say, or we can just wait for questions. Thank you.
This is
Thanks,
Mike
Justin.
Champness.
Go ahead.
Thanks, Justin. James, do you mind if I jump in?
Please go right ahead, Mike.
Okay, thanks. I guess as we are collecting questions here, maybe I'll start with the first one, Justin. The last time we had you in our office, you discussed the idea that interest rates may be in the midst of a sort of a lower for longer environment. You started to touch on that a little bit. This is a common phrase in the press, but specifically you discussed how demographic data could support that thesis, and couple that with another topic that's covered in the media known as sort of modern monetary theory, with the overarching idea that governments can print money without inflationary consequences. And that discussion, like I said, the last time you were in our offices really stuck with me, and I was hoping you could share maybe some of that data and research that you have to analyze the potential for this sort of lower for longer environment and what that might mean. Thanks.
Thanks, Mike. So that's a great question. At Wasmer Schroeder, we're not big believers that, especially in the short term, you can bet on interest rates well. But there has been my entire career this worry that interest rates are going to go up. That especially happened after 2008 with quantitative easing, that we were going to have massive inflation, that the stimulus act back then and growing deficits would cause higher interest rates. Fast forward 10 years and we're at all-time low interest rates. I think there's two pieces to the answer. I think one is that we have had inflation, but it's been different than the past in that we've had financial asset inflation. So the prices of bonds, equities, other asset classes, as opposed to inflation in stuff. A book, a desk, a piece of furniture. More importantly, and look at Japan as a guide, who have been trying to stimulate their economy and get inflation for well over 30 years and have borrowed heavily to do that. It hasn't worked. And looking at a lot of the research, it comes down to a pretty simple concept. When your population is flat or declining and it's aging, it's very hard to get inflation because you're not growing new consumers, and those consumers you do have are getting older. So there's some general data out there that about age 46, the average American is at their peak spending year. They have kids in high school or college. They're in their biggest house. They're maybe not at the peak of their earnings, but they're pretty close, and they're just writing checks like crazy. Once you hit 65, the average American spending falls about 1% a year. So looking at it from that way, we have this big baby boomer population that's going to be spending less and less every year, and a mid-40s population, which is much smaller than the baby boomers and can't support them. And on top of that, as of 2018, the U.S. population growth was only about 0.3%, the lowest since World War I. And so we're really not getting more people to be future consumers. So that really underscores our view. If we're not going to have more consumers and we're not going and they're aging, it's really difficult in our mind, other than in very temporary periods, to have any meaningful inflation. And that really underscores our view that we will have this lower for longer environment.
Thanks, Justin. Before we answer some more questions, I want to just remind everyone there are two ways to submit questions. One, for those of you following along with us on a computer, is to do widget on the right side of your screen. And for others, you can email questions to Susan Curry at klingenstein.com. That's SUSAN dot Curry, CURRY, at KLINGENSTEIN.com. I think we do have some questions coming in, so maybe Ellen, if you want to throw some of those to us, I know Justin or Mike or myself would be happy to try to answer them.
Sounds good, thanks. So one question is, James or Justin or Mike, you talked about how the news, and the equity markets are reacting mostly to news in the short term. Can you talk a little bit about the bond markets? Are they as susceptible to short-term shifts based on news coming out? And are there different parts, are munis more susceptible, say, if, you mentioned Texas in particular?
So this is Justin again. The bond market is absolutely susceptible to news. It's sometimes susceptible in a different way. I think as bond investors, we're a little more pessimistic than the equity people. So maybe we see the glass as half empty more often than we should. And you see that with what happened in March with corporate and municipal credit spreads rising significantly and yields on those bonds rising. I do think, however, the nature of the market, especially the muni market, is most investors are typically more buy and hold. There's less turnover. They're in bonds for a reason, and typically that reason is income. And so there tends to be a little bit longer term view in understanding credit or holding periods or credit spreads, which I think is a good thing. I think especially in an environment like this where we don't know so much. This has happened so quickly and we're still getting data in. It's really important to take a long-term view as opposed to taking a very short-term one. A month ago, the COVID numbers were looking like they're improving, and now, sitting here in Florida, we're having the highest numbers we've had since all this has started. So really thinking about the long-term effects on the economy, how consumer behavior will change, what will go back to quote unquote normal, and what will change forever. This is a giant experiment in teleworking, and what that does to many industries like the asset management industry or technology industry and where and how people work may have wide-ranging consequences far beyond just COVID and this particular pandemic.
Great, thank you. Another great question. In the last rounds of QE, people talked about how this was going to have long-term effects once the easing stopped. Things were going to go crazy. That didn't happen, but the level is so much higher now. Are we kind of kicking the can down the road and will it come back to bite us? Sort of, not to use colloquial, but that was what it came in as. I'm going to give that also to you, Justin, if you don't mind.
Sure. So one thing I've learned in my career is you can kick the can a lot of times. There is probably a day of reckoning. It could be in a much longer time frame than we might think. I think it's also important, and maybe this changes, and maybe this is a tipping point. There's real value in the U.S. in that we are the world's reserve currency. And as long as we maintain our reserve currency status, we can, quote unquote, get away with a lot of bad behavior and still make out okay. I think where you'll really see it is less at the federal level, because it's easy to run deficits because they can print money, is how it plays out in the state and local level where they're required to balance budgets. And this really gets back to my previous comments about looking at policy and policymakers and who are making the tough choices and who aren't. So a good example would be after 2008, both California and Illinois were the poster children for horrible finances, too much debt, deficit borrowing. Fast forward 10 years, California's gone from BBB plus rated to AA rated. They're setting on a $20 billion rainy day fund. And up until this, we're running a very large surplus. They made a lot of tough decisions. They slashed government spending throughout the state, and they raised taxes and revenues as well to get their fiscal ship in order. On the other hand, Illinois hoped that things would get better and really made no substantive changes. And here we are today with one of the worst pension funding ratios in the country. And they are the lowest rated state on the brink of being below investment grade. And again, they actually had, from a just purely economic tax structure base, they had more room to make changes than California did, but politically they just weren't willing to do it. So that again gets to how we're viewing credit is less about, we all have to deal with COVID. Every business, every municipality, every enterprise system, it's how we deal with it that's going to be most important for credit quality going forward.
Great, thank you, Justin. Another pair of questions I'm going to toss over to you, James and Mike, in relation to allocations to fixed income. And these are sort of related, so I'll give them to you in a group and you can address them together. One is, have you made any changes to the overall allocation to fixed income and among different categories? And sort of related to that, if a family, that meets the need for income and fixed income with the low rate environment, how are you structuring portfolios, or how are you thinking about portfolios that is different?
Thanks, Ellen. That's a great set of questions. Asset allocation, which we would argue is more important ultimately than even security selection, in that if you get the asset allocation wrong, it becomes less and less important if you get the securities in each sub-asset class correct. We consider to be critically important. As to our thinking around asset allocation, we've gotten this question or a corollary frequently, particularly with the equity markets bounce off the March 23rd lows, in that the equity portion of most client accounts is either at, or in many cases, at or above where they want it to be, their target. And so the question arises in this rate environment, what do you do with the non-equity portion of your portfolios? And certainly we've thought about fixed income, both the types that Justin was referring to around municipals and government bonds, in some cases corporate bonds, and in many cases alternatives that may have fixed income like structures such as real estate or other structures, hedged equity and things like that. We also think that when clients have an income need, which I know is part of this question, is thinking about two things. One is the total cash flows and income from the portfolio. It isn't often the case in the low interest rate environment of the last decade that equities themselves have a higher yield, for example, in the S&P, than you may be getting from the Treasury complex. So when we think about income for a client, we don't just think about the fixed income portion. Fixed income is often for income, of course, given the name, but it's also to provide more stability and less volatility for the portfolio. So when we think about income needs for a client, we think about the income produced from all the asset classes, not just from the fixed income piece. And the second of it is to think about total return. If a client is really going to have income needs over time, we may or may not be able to generate that purely from cash flows from fixed income instruments or equity instruments, but rather have to take a total return approach to get the risk piece of it correct, understanding that to provide the ongoing cash needs for a client, we may have to sell securities as we go, but that on a total return basis, that's a better way to fund the income needs for a client. Mike, I don't know what you would add to that, and I'd love to ask a follow-up to this questioner's question to Justin, which would be how they think about more the high yield complex in what's happened in the last few months or year to date, and whether or not you're getting paid for the risk you're taking if you go into high yielding fixed income.
Sure, thanks, James. So we don't do corporate high yield, so I'm not gonna comment on that. We do have we do follow the municipal high yield market. I think even before COVID, we were getting nervous about municipal high yield for really two reasons. Is one, over the past couple of years, because everybody is searching for yield and income, there's just been too much demand relative to the supply. And so a lot of high yield deals have been very covenant light, and deals that wouldn't have been able to get sold 3 or 4 years ago were being sold. So we really think that kind of 2018 and 19 vintages of municipal high yield deals will probably do worse than ones sold after 08, 09. A good example would be the American Dream Mall in Palisades, New Jersey, which has really been a disaster for a decade, but got financed about a year and a half ago, and it looks like they're probably already going to default. I think the other piece is that high yield doesn't really mean high yield anymore. When a 10-year AAA municipal bond is about 80 basis points, getting 2% over that is still only 2.8% a year. And when your magnitude of risk is going up, in our minds, by a lot more than that, it doesn't make sense in a lot of cases. You know, there are always a few opportunities here and there, but this isn't like back in 08 and 09 where you could buy BBB munis at 8 or 9% tax-free. You know, the absolute rate of return relative to risk just doesn't make a lot of sense in our minds right now. So we're in generally a de-risking mode, both because of COVID and because of the absolute low rates in this environment.
Justin, this is Mike. Can you just clarify, you used the phrase covenant light. Can you explain what that would mean to a bond investor?
Sure. So a covenant is just some sort of legal structure in the bond documents to protect bondholders. So that could be that an issuer isn't allowed to issue additional debt until their debt per capita is below a certain number, or they need to raise rates on their water and sewer system or their entry fees for a senior living facility so that they cover debt service by 1.5 times every year. And what's happened is a lot of those have become a lot skinnier. So maybe 3 or 4 years ago, a high yield deal might have debt service coverage covenants of 1.5 times annual debt service, and they go down to 1 times or 1.1 times. So you have a lot less room for error when you have weaker covenants protecting you as a bondholder than in the past. And that happens in the corporate market as well. When everybody wants something, the issuers can get away with not giving themselves more flexibility at the expense of the bondholders.
Thanks.
Great, thanks. I think we have time for a couple more questions. So I'm gonna throw this out to both, to all of you on 2 different levels. We've had a couple questions about taxables, about corporate investment grade bonds, in terms of, given the rate environment, how attractive are they on a risk return basis, and where you see the outlook for corporates. And again, in terms of portfolio use, obviously, how they factor into allocations.
Yeah, the good thing about the corporate market is it's highly liquid. It's highly sophisticated. The disclosure is good. You know, our view again is we're pretty constructive on most A-rated and higher corporates. We do have some concerns about the BBB portion of the market just because of the amount of leverage they have. In the short run, with this rally, issuers have borrowed a ton of money to get them through this uncertain economic period. So in most cases, in most industries, we think issuers will be able to weather it. I think the really big question is on a sector by sector basis, you know, when are a significant number of people going to be willing to fly? When are a significant number of people willing to go on a cruise or a theme park? When are they willing to go to a concert? That to me is really the biggest question, is how do consumers change, not just in the short term, but in the long term. You know, anytime we have shocks, whether it's wars or here a pandemic or market crashes like in 08, consumer behavior can change even after the crisis is gone. And so we're spending a lot of time at Wasmer thinking about the corporate market, the muni market, and saying, what do we see around us, and who are the winners and losers are going to be? You know, we're already seeing that, you know, online sales are going through the roof. You know, retail was already dying. Does this mean it just accelerates it, and that commercial real estate in the retail space could fare even worse than it's been? You know, office space is another example. You know, most of our company is working from home, and we don't know how long that'll go. And do companies realize that they don't need to spend as much money on high cost, you know, downtown large city locations? Those are the things that we need to be on guard for and be able to have the agile mind to change our minds if the world changes around us. So short-term answer, we're pretty constructive on corporate credit. Liquidity's back, spreads seem reasonable. Long-term, I think it's really going to be a sector-by-sector, issuer-by-issuer analysis.
Great, thanks, Justin. I think we have time for one more question, and we've had a couple of questions. I know this was not really the topic of today, but in terms of non-US, either sovereign or corporate debt, fixed income, does that play a role in investors' portfolios at Klingenstein Fields Wealth Advisors? So James and Mike, I'll throw that one to you.
Yeah, thank you, Ellen. It's a really good question, and I know it's not the expertise of any of the three of us panelists, but I would say this: everything that Justin said about the work that Wasmer does applies equally to international markets, with a few additions. So, for example, the credit quality of the issuer, the covenant and indenture structure, the legal regime under which the securities are issued, the currency aspects, which is not an issue if you're a dollar investor and investing in dollar bonds and the revenues to the issuer in dollars. These are all additional considerations. And then, of course, there's the credit quality of the issuers, the credit quality of the sovereign. There's a number of factors in addition to all the ones that Justin and his team apply to the markets that they do follow that you have to consider. And when we've done work in international markets, and I had done some earlier in my career as a bond investment banker, you can have an incredibly great credit that does exactly what it's supposed to do, and the currency moves against you, and all of your income is wiped out. So, and the opposite can be true as well, of course. So I think there's a number of additional areas of focus you have to consider in looking at non-U.S. issuers and non-U.S. debt, in addition to all the things that need to be done for any type of credit structure. And I don't know what Mike, you or Justin would add to that.
I have nothing to add.
Well, thank you guys for all the questions, and gals. We really appreciate it. Thank you so much, Justin and Mike. That was really a very helpful recap of what's been going on in the fixed income markets. We thank everyone for attending, and we certainly hope you found it interesting. We'll continue to keep you all updated on our perspective on the markets, equity, fixed income, and others, as well as special investment and planning topics of interest. We certainly encourage any and all of you to suggest topics for future webinars. We hope everyone stays well. We look forward to speaking with you all very soon. Thank you again for attending.